Hello students, welcome back to the virtual class. Today we are taking up with the concept under 5th chapter, review and reporting. So the today's topic is going concern. See, the going concern is a business the function without threat of liquidation for a foreseeable future, usually regarded as at least within 1 month. So such business organization or such entities are termed as a going concern, which is not having any threat uh, towards a liquidation, and it is having a continuity and consistency in its operations. Okay, so the going concern principle allow the company to defer some of its prepaid expenses until future accounting period. The going concern assumptions is a fundamental assumptions in the preparation of financial statement. Okay, and a going concern assumption, any entity is orderly viewed as continuing in the business for the foreseeable future with neither the intention nor the necessity of liquidation, casing trading or seeking protection from creditors pursuant to law or regulations. So this is about going concern. Okay, we have a certain significance for the financial statement. Okay, so financial statements are usually prepared on a basis of the reporting entities in a going concern. Okay, so IAS 1 represents a representation of financial statement states that an entity should prepare its financial statement on a going concern basis. Okay, unless the entity is being liquidated or has ceased trading. Okay, the directors have no realistic alternative but to liquidate the entity or to cease trading. Okay, then whether the assumption is made that the company will cease trading, the financial statements are prepared using a breakup basis under which assets are recorded at likely sales value. Inventories and receivables are likely to require more provisions. Additional liabilities may arise: surveillance cost for staff, the cost of closing down facilities, etc. So these are all the significance with respect to financial statement when it comes to going concern. Next we have directors' responsibilities as well as auditors' responsibilities with respect to the going concern. Okay, it is a director's responsibility to assess the company's ability to continue as a going concern when they are preparing the financial statement. Okay, if they are aware of any material uncertainties which may affect this assessment, then IA AS1 requires them to disclose such uncertainties in the financial statement. Okay, when the directors are performing their assessment, they should take into account number of relevant factors such as current and expected profitability, debt repayment, sources of financing. So this is very important for an entity to check whether it is a going concern or if there is any uncertainties with respect to running its business. So these are all the director's responsibilities. uh, then we have a auditor's responsibility here. So here auditor, according to the ISA 570, going concern states that the auditors need to consider the appropriateness of management's use of going concern assumptions. Okay, the first one is auditor need to assess the risk that the company may not be in a going concern. The auditor will also need to obtain sufficient appropriate evidence that the company is a going concern. Where there are going concern issues, the auditor need to ensures that the directors have made sufficient disclosure of such matters in the notes to the financial statement. Okay, this is important from auditor point of view. Then we have a certain set of indicators with respect to the going concern. The first one is net current assets. Net current liabilities or net liability over indicates an inability to meet debts as they fall due. This is one indicator with respect to the going concern. Then borrowing facilities not agreed or close to expiry of a current agreement. Lack of access to the cash may make it difficult for a company to manage its operating cycle. Then default loan agreement normally become repayable on default. Company may find it difficult to repay the loan. Unplanned sales of non-current assets indicates an inability to generate cash from other means, and as a non-current asset generates income will causes a decline in income and their profit. Then misleading tax payments results in fine and penalties. Company normally prioritize tax payment, indicating a lack of working capital. Then failure to pay staff indicates a significant negative cash flow, indicates over trading. Inability to obtain credit from a supplier suggests failure to pay suppliers on time or working capital problem. Major technology changes, inability or insufficient fund to keep up the changes in the technology will result in loss of custom and obsolescence of inventory. Then legal claims, successful legal claims may result in significant cash payment that can only be settled with liquidation. Then loss of key staff may result in inability to trade. So these are all the indicators of going concern. Well, we'll move on to the next concept, that is written representation. Written representation is another concept in the 5th chapter. Okay, so here audit evidence is the information used by auditor in arriving at the conclusion on which the auditor opinion is based. So written representation contain the necessary information that the auditor required in connection with the audit of the entity's financial statement. So written representation provide information about the auditor requirements in connection with the audit of a particular company's financial statements to hear certain set of purposes which were associated with written representation. See here, to obtain the representation that management and those charged with the governance have fulfilled their responsibility for the preparation of financial statement includes the following. Okay, preparing the financial statement in accordance with an applicable financial reporting framework, providing the auditor with all relevant information and access to records, recording all transactions and reflecting them in the financial statements. Okay, to support other audit evidence relevant to the financial statement if determined necessary by the auditor or required by ISES. Okay, so these are all the purpose with respect to written representation. Then we have a certain set of objectives. So your auditor should obtain a written representation from management, those charged with the governance when appropriate, that they believe that they have fulfilled their responsibilities. Okay, for preparation and fair representation of the financial statement and for a completeness of information provided to the auditor, or to support other audit evidence relevant to the financial statement or specific assertions in the financial statement by means of written representations if determined necessary by the auditors or required by the AUC sections, to respond appropriately to written representation provided by the management, and to respond appropriately if management does not provide the written representation requested by the auditor. So these are all the basic objectives of auditors when it comes to written representation. Then we have a requirements with respect to provide a written representation. It is consisting of fraud. Okay, so it's responsible for a design, implementation and maintenance of internal control to prevent and to detect fraud. Okay, then laws and regulations, identified or suspected non compliance with the laws and regulations have been disclosed to the auditor. Then uncorrected misstatement. See, the effect of identified uncorrected misstatements individually or in the aggregated are immaterial. Then litigation and claims, the effects of all known actual or possible litigations and claims should be considered in the preparation of financial statement and disclosure for the applicable financial reporting framework. Then estimate the reasonableness of significant assumptions used in making accounting estimates. Then related party transaction, see the disclosure of all related party relationships and transactions of which it is aware. Okay, then subsequent event, all subsequent events require adjustment or disclosure required by the applicables. Okay, all this is the auditor should require management to provide a written representation. Okay, then we have a next one, audit finalization procedures and sufficiency of evidence. So audit review procedures and sufficiency of evidence includes the following: an understanding with management and, if applicable, those charged with governance regarding a review of financial statement should be included in the following matters, which includes the objective of review is to be obtained limited assurance that there are no material modification that should be made to the financial statement in order for a statement to be conformity with the applicable financial reporting framework. So a management is responsible for the period and for representation of the financial statements in accordance with the applicable financial reporting framework. Then management is also responsible for designing, implementing and maintaining internal control relevant to preparation of fair representation of financial statement. Management is responsible to prevent and detect fraud. Management is responsible for identifying and ensuring that the entity complies with the laws and regulations applicable to its activities. Then design and performance review procedures includes the following. Okay, it is based on accountant's understanding of the industry, his or her knowledge of the client, his or her awareness of the risk that he or she may unknowingly fail to modify the accountant's review report on financial statement that are all material misstated. Okay, then we have dealing with uncorrected statements. So auditor responsibility to evaluate the effect of identifying misstatements on the audit and of uncorrected misstatements, if any, on the financial statements or to be dealt with this. Okay, see, uncorrected statements means whatever the misstatements they have created, they made in the financial statement while preparing the financial statement. It may be due to different errors like vomiting, error of commission, all such errors. See, after misstatements, after identifying a misstatement, they have to correct it. If it is not corrected, that will be termed as uncorrected statements. Okay, so we have on objectives: the effect of identified misstatements on the audit, then the effect of uncorrected misstatements, if any, accompany the financial statement. Okay, so this is the objectives with respect to the uncorrected statements. Then we have evaluating the effects of uncorrected misstatements. So prior to the evaluation of the effects of uncorrected misstatement, the auditor shall reassess materiality to confirm whether it remain appropriate in the context of entity's actual financial results. Then the auditor shall determine whether uncorrected misstatements are material individually or aggregated. In making this determination, the auditor shall consider the following. See, the first one is the size and nature of a misstatement, both in relation to particular class of transaction, account balance, or disclosures in financial statements as whole, and the particular circumstances of their occurrence. And the effects of uncorrected misstatement relating to prior period on relevant class of transactions, account balances or disclosures and financial statements as communication with those charged with governance includes the following. See, the auditor should communicate with those charged with governance uncorrected misstatements and effect that they individually or in aggregate may have on opinion in the auditor's report, unless prohibited by law or regulation. Then auditor shall also communicate with those charged with governance the effect of uncorrected misstatements relating to prior period on the relevant class of transaction, account balances, disclosures and a financial statement as a whole. Then representation and disclosures of segment information in accordance with the applicable financial reporting framework. So this is all evaluation and the effects of uncorrected misstatements. So thank you for watching the video. Have a great day.